In today's video, we'll clarify the difference between a call option and a put option in stock trading. Just a small disclaimer up front, this video does not constitute investment advice and is intended for informational purposes only. Trading stocks and derivatives always involves a high risk of loss. Let's get started. With a call option, the buyer of the option has the right to purchase a stock at a specified price, while the buyer of a put option is granted the right to sell a stock at a specified price. Options are generally divided into two different types, American and European. With the American type, the option can be exercised at any time, whereas with the European type, the option can only be exercised on a specific date. So far, so good with the theory. Now let's take a look at this with some concrete examples. In the first example, we purchase a call option on the stock of Dairyware Corporation with the so-called strike price of 50 euros at an option price or cost of 5 euros. The purchase price of the option is therefore 5 euros, and the strike price means that by acquiring the call option, we obtain the right to purchase the stock at a price of 50 euros. The strike price is thus set at 50 euros. Corporation has performed very well in recent months, so the stock price has risen to 75 euros by the expiration date. But what profit or loss have we achieved with our call option? Since our strike price is 50 euros, we exercise the option to buy the stock for 50 euros, resulting in a profit of 20 euros because the stock is currently trading at 75 euros, and we must subtract the 5 euros we paid for the option. Thus, we can purchase the stock significantly cheaper than the current price. Alright, but what if Dairyware Corporation had not performed well by the expiration date and the stock price had dropped to just 15 euros? What profit or loss would we be dealing with in this scenario? Since the option gives us the right, but not the obligation, to purchase the stock for 50 euros, we naturally choose not to exercise the option and let it expire worthless. Therefore, the loss from the call option is 5 euros, which is simply the price of the call option. Okay, next we're interested in a put option on the stock. Here, we first purchase a put option with a strike price of 100 euros at a cost of 5 euros. The put option grants us the right to sell the stock at a price of 100 euros. In our example, the stock is only trading at 75 euros and does not reach any value above that, as indicated by the dotted line. Once again, we ask ourselves what profit or loss the put option has generated for us. In our example, we exercise the put option and collect 100 euros from selling the stock. The difference from the stock price at the expiration date represents the profit from exercising the option, which amounts to 25 euros. We then subtract the 5 euros paid for the option, resulting in a profit of 20 euros from the put option. So, 100 euros minus 75 euros minus 5 euros. Alright, but how would the value of our put option have behaved if the stock price of Dairyware Corporation had increased? In this example, our strike price is again 100 euros, while the stock price at the expiration date has risen significantly and is now trading at 125 euros. Naturally, we again wonder how our put option performed. Since the stock price of Dairyware Corporation is significantly above our strike price at the expiration date, we choose not to exercise the option and let it expire worthless, because we could sell the stock at 125 euros even without the option. However, we still have to pay the 5 euros for the option, resulting in a total loss of 5 euros from the put option. Therefore, options can lead to both gains and losses, and always come with a cost. We hope this video has helped you understand the topic of stock options. See you next time and have a good one.